And I do believe that 21 and 22, which were terrible years for long duration assets, our kind of strategy, long-term bonds, the worst bear market really in history since the 1700s. We've paid our dues. And now I do believe that what we were projecting or forecasting, and have been for quite some time, is that inflation, when history is told, inflation was transitory and a function of a supply shock and supply chain bottlenecks, and that it flipped pretty quickly from inflation down to 2%, past 2%, and into negative territory. That's what we think is going to happen this year. So I think the Fed will take note. And then the other thing that we believe will, with history as our guide, become obvious is that we've been in a rolling recession for roughly 2 years now. A number of housing measures are down 40%. New and existing home sales was threatening to do so in the last 5 to 10 years. It did so decisively during COVID. Now, one thing about this is these are two different kinds of measures. Debt outstanding is a what they call a stock. It's an absolute number, level of debt. GDP is more of a flow. It is a measure of the goods and services produced in any year. And if we're dealing with a quarter, it's annualized. So again, any year. So different kinds of statistics. I think the debate is serious, but I don't think it is as serious as many think it is if we are right that innovation solves problems. And we're going to go into a period, thanks to unbelievable amounts of innovation. You just heard about Bitcoin. We believe that real GDP growth is going to be turbocharged. The 73 to 75 recession, the 1980 to really, it was one big recession from 80 to 83. And then you can see where we are now. It's even more in terms of consecutive days than 08, 09. So if you were using this chart alone, you'd say, oh my goodness, what kind of recession is this going to be? Again, we've been through a rolling recession. I think that's partly what this chart is telling us. And we don't think the recession is going to be severe, but it is going to be something the Fed will have to address. Here is the Federal Reserve Bank of New York recession probability. It has been saying for quite some time that we're going into a recession. And in fact, late last year, we got to a level where we had only been in the early 80s before. So, but these votes at the Fed have been unanimous, which is kind of crazy, because each of the Federal Reserve banks, it was up, it was higher than forecast at, I think it was 216,000. Expectations were 175, but revisions took the net down to 146. So revisions, and in fact, we didn't put it in here, but job revisions to the downside have never been as strong, meaning the downward revisions have never been this steep to the downside ever. And temporary help employment, which is the purple line, corroborates this notion that employment is fraying at the edges, and household employment today was down, I think, roughly 700,000. So it disagrees, and that's a household survey versus a corporate survey. They are disagreeing right now. And so again, something for everyone. Wages higher than expected, hours less than expected. So again, something for everyone. It's for the last, I'm going to say 15, 20 years, we're in a downtrend in terms of commodity prices. And today, breaking below 100, we are where we were in the early 80s. This is not an inflationary chart. In fact, if anything, if you look at the last decade, this shows a downtrend in pricing. And we think that the Fed will do a double take as it reassesses during the next year. Here, I showed you this chart a couple of months ago. The metals to gold ratio, so that's metal price index divided by gold price index, that is the purple line. And it is near its low. It's been highly correlated to long-term interest rates, especially since the 08-09 crisis. Look at that beautiful correlation. They're basically running together until 2022 and 23. And when we first presented it, I think it was in October, the long-term treasury yield was up 5, and you could see this metals to gold price index dropping. Debt, too much debt, not so much in the government sector, but in the corporate sector, maybe the consumer sector, and bankruptcies. The one thing I'm looking at, and we are looking at, is private equity rushing in to provide loans out there. And so while banks are saying no more and cutting back, private equity is in there saying, no, here, for this very high yield, we'll fund you. And I don't think that's going to end well. I don't think that's going to end well unless we have a burst of economic growth. And so if it's not going to end well, I'll end by saying innovation solves problems. And actually, Yassine stole my punchline. I was going to use it at the end of this In the Know. And that is that Bitcoin is a risk-on asset, but it is a risk-off asset as well. And if there are going to be bankruptcy problems out there,